When a Canadian taxpayer decides to leave Canada or become a non-resident for tax purposes, whether permanently or temporarily, it's essential to consider the various tax implications that can arise from this change in residency status. I delve into the key tax considerations for Canadians looking to change their residency status and explore some tax planning strategies to minimize tax exposure. Essentially, there are three types of residency status: resident, non-resident, and part-year resident. To determine one's tax liability, first, an individual must determine their residency status for tax purposes, as well as their provincial or territorial residency status. Canada Revenue Agency, CRA, considers various factors to identify an individual's residency status, such as the individual's ties to Canada, the duration of their stay abroad, the purpose of their stay abroad, and their ties abroad. Knowing your residency status is crucial for making informed decisions about your tax obligations. Non-residents of Canada are required to file an income tax return if they have taxable income from Canadian sources, dispose of taxable Canadian property, or elect to report Canadian rental income on a net basis. It's important to understand which specific forms of non-residents are required to file to avoid penalties or reassessments from the CRA. If a non-resident of Canada earns income from Canadian sources, for example, from employment or investments in Canadian assets, the non-resident could be liable for Canadian taxes. Typically, non-residents are subject to a 25% withholding tax on certain types of investment income from Canadian sources. This withholding tax rate may be reduced under the tax treaty between Canada and the non-resident's country of residence. Certain types of taxable Canadian property can trigger tax obligations for non-residents, such as owning real estate or Canadian resource property. When an individual ceases to be a resident of Canada, they are deemed to have disposed of their worldwide assets for fair market value. As a result, departure tax may apply to any accrued capital gains, even if the assets are not physically sold. This can lead to a significant tax burden for an individual in the process of changing their residency status. Fortunately, there are certain exceptions to this rule, such as the exemption for certain assets like Canadian real estate, registered pension plans, and property used in an active business carried on through a permanent establishment in Canada. Considering the tax implications of a change in residency status, it's vital to develop a tax planning strategy. Consult with a tax professional who can analyze your unique situation and recommend the best course of action to minimize your tax exposure. Some possible strategies include severing your residential ties with Canada to become a non-resident, taking advantage of tax treaties between Canada and your new country of residence, timing the change in residency status to minimize the tax impact, properly reporting and managing any tax implications related to the ownership of Canadian assets, deferral of departure tax liabilities, managing the tax impact of registered and non-registered investments and pension plans from both a Canadian and foreign tax perspective. Remember that tax laws vary from country to country, and you may face different tax obligations in your new country of residence. A tax professional with experience in both Canadian and international tax issues will be a valuable resource in navigating these complexities.